Let's welcome in Matt Orton, U.S. market strategist and chief market strategist at Raymond James Investment Management. Thanks very much, Matt. Great to have you with us here. Thank you very much for your time. You know, the big question is the question on flows. So let's just begin there. Although even as we're starting to get headlines out of China, but I think we'll maybe give it some time, and then we'll get a full perspective of what's happened and whether the actual measures match the rally that we've seen there. Now, tell me if this is the right way to look at it. So if you look at FII assets, FII AUM, foreign AUM in emerging market funds, it stands at about $1.2 trillion. It stood at $1.2 trillion or so. And should we, a 10% swing means about $12 billion. Now, we've seen selling across emerging markets over the last 5-6 days as China has continued to rally hard. Is that could we look at this data point to kind of see, well, how much more to go? And how does one use this data if there is any use at all? Go on.
Hey, Prashant, always good to see you. And I think, looking at the emerging market complex in totality makes sense. I think to get a good sense of just the flows that are happening with FIIs is even taking simple ETFs in the US. So you look at FXI, which is the most liquid Chinese ETF. You had $3.7 billion flow into that over, call it 2 weeks, which is incredibly significant, the most significant amount of inflows we've seen versus India year to date for the top 2 ETFs in the US alone. We've only had about $3.2 billion come in on an entire year to date basis. So there's a significant imbalance there with respect to the flow of funds. So I think that just speaks to the fact that investors have consistently underweighted India with respect to the entire broad or emerging market complex. And that underweight is only becoming more persistent as you see a lot of assets flowing into China. And the issue that causes is when you have disappointments. I've been following some of the headlines that have been coming from the conference today. We don't have any new news, and the market's expecting to have new news, and there really has been no significant policy updates there. And so you're going to see a pullback. So I suspect once that rising tide stops lifting all boats in China, you're going to start to see some of that capital take profit and move back to other areas. So I don't think this is time to say India is done, that this is over. I think India is only becoming more attractive because it's actually buttressed by real fundamentals, as opposed to China, where it's still a show me story, and I'm still waiting to see actual measures that are being put in place.
Matt, hi. Good morning. Good to have you on. That exactly seems to be the problem right now, right? The Hong Kong market, the Hang Seng, selling off 7% as we speak, and the mainland gains have been pared down to just, I think, 4% now from that 10% surge at the open. What is it that could keep the China market going? I know everyone's talking about direct consumer spending, money in the hands of the consumer for direct demand boost. If that doesn't come through, and if the measures are more indirect, then do you expect this whole sort of sell India, buy China, or sell other emerging markets, buy China? Will this trade start reversing quickly, or will people preserve their bets?
Yeah, I think the trade will slow down considerably. I think the bets are still going to be on because I think investors are going to wait to see if economic data actually improves. At the end of the day, China was a significant short position on the part of a lot of investors. It just had been under-owned. Valuations across a lot of parts of the Chinese market are still arguably very cheap, even after a 30+% rally. So I think there's going to be a little bit of a longer leash. But like we're seeing today, the leash is still there. I think investors are going to be increasingly impatient with respect to seeing results or actual policies being implemented by the Chinese government. And if we don't see that, and I think we really need to see on the area of probably 5 trillion yuan of fiscal stimulus that's directed towards the consumer in order to actually hit GDP growth targets and really instill confidence in this investment savings issue that has put China into secular stagnation. If we don't start to see progress towards that, I do think investors are going to start to bail. And as a result, I think you're going to start to see some of those flows reverse back into India again and try and find other parts of the market where the fundamentals are there. I don't think that needs to happen to see money start to flow back into India, but I think that would certainly accelerate the story.
You know, it rarely happens that it's so clear cut and clean, right? That look at what the GIFT Nifty is trading, right, Matt? And for our viewers, GIFT Nifty is recovered over 100 points. 18 minutes back when we started the show, actually less than that, we were looking at the GIFT Nifty down 100 points. That's down 20 points now. And I think, so this is GIFT Nifty's gone like this, and you've got the Chinese index, the Hang Seng specifically, which is actually climbed lower. So it's kind of a very clear sort of trades on both ends of the spectrum. And as I said, it rarely happens in such a clean and pronounced way, but I think things got to a bit of an extreme on both ends. So that is what is playing out. So quite incredible, Nigel.
And that extreme positioning, I think, is gradually going to, converge, and it's coming back to normalcy. So I guess that's why it's giving us added reason why we could see some kind of a relief rally here in India. So let's see how that goes. And crude oil prices as well, I think from the highs that we saw overnight, $81 per barrel, that's come off a little bit. So that's good news as well, because that's the worry from a bullish perspective. Now moving towards $79 per barrel. So good downtick is what we've seen out there. Matt, good to see you in the show as always. Well, we've got a bit of a dip here in the Indian markets. Everyone was asking for a dip. Well, you've got more than your share, 5 to 7% correction on most indices in a matter of 5 sessions. And you have kept your shopping basket ready. What all do you like at these levels?
Yeah, hey, Nigel, good to see you. And I think that's the most important message to give investors right there, is that when the fundamentals remain in place, like they do with India, have your shopping basket ready, because I've been encouraging our clients, there's no need to chase the market. Use downside opportunistically. And the downside we have in India, I think, is very, very attractive. So you look at just some really high quality names. I've talked about them here before, but I still have a lot of conviction in names like Mahindra and Mahindra. I mean, the pre-orders that you've had for rocks are incredible. You're after coming out of monsoon season, you're going to start to see, I think, the farm implement business pick up, which is accretive to margins as well for the company. So I think there's opportunities there. Same thing with ICICI Bank. The growth story there of finding a solid upper teen ROE compounder is very, very difficult to find. And a name like that, when you do have the opportunity to pick up on some downside, that continues to look very, very attractive. And then China or not, I think some of the commodity names that are related to steel, related to infrastructure, those parts of the market still look very attractive. And I still also like names like Adani, SEZ, because it's the infrastructure theme again, but ports bringing in, developing, also investments that the company is making overseas with a very strong balance sheet. That's very, very attractive to me going forward. So I think this is a great opportunity for investors not to panic, but make sure that they are putting money into high quality companies going forward. And that's what's going to serve them very well over the long term. So I look at this as an opportunity.
Well, good to have an optimistic view in the morning. Matt, thanks a lot for joining in. And as we went through that conversation, the SGX, the GIFT Nifty that was down 100 points, now it's moved into the green. Wishing you a good day ahead and looking forward to chatting up with you rather soon.